Welcome to another edition of What the F Just Happened. This is Eric Dubin along with Dave Kranzlin, recording on June 15th after a pretty big smash down in precious metals following yesterday's interesting action as the markets digested Draghi coming out and speaking to what the ECB's policy is going to be on a going forward basis, as well as the Federal Reserve coming and making their noises with their FOMC meeting earlier this week. So, Dave, we've got a lot to cover here. The precious metals, particularly silver, was doing some pretty interesting trading. We got into the 17 handle, and people were in a position to be able to benefit from SLV options. But more importantly, the metals have been performing really strongly. Even when yesterday we saw strength in the dollar, people were coming back into the precious metals market, and the positions that the bullion banks have were at threat, and they're at threat of losing control of the precious metals space. What do you think's going on?
Dude, what the F just happened today in gold and silver? Wow. Did you get the number of that bus that hit me?
Yeah.
Today, I mean, it was a typical drive-by hit and run by the Comex bullion banks. I mean, we've seen this movie repeat over and over again. The banks build up their short position in gold and silver. The hedge funds get a little bit over their skis in terms of longs. And the banks take a quiet Friday like today, and they massacre the price of gold and silver, and they use that sell-off to cover their shorts. And, you know, I could calculate it out by hand, but I guarantee you the banks made tens of millions of dollars today covering their gold and silver shorts. And, I mean, it's as simple as that. It's not any more complicated than that. That's what happened. And today happened to be a particularly quiet Friday. There was probably a lot of traders who didn't even show up for work. They went out to Shinnecock with clients to watch the U.S. Open. So today was the perfect setup for gold and silver to get hammered like this.
We saw a pretty significant rise in the contracts for open interest. Comex gold contracts rose by 10,210 contracts yesterday as people were, as the gold cartel was addressing and sopping up the influx of demand for gold, trying to keep a lid on this. We saw the same thing happen in silver as well. I mean, the open interest in silver is now 232 plus thousand contracts open, and we haven't seen levels like that. I mean, that's even above where we were, frankly, back in 2011 when we peaked out at nearly $50 silver. The amount of effort that's being put in to sop up demand that periodically washes into this sector is monumental.
Well, I mean, yeah, it was about the commitment of traders and how the banks were set up versus the hedge funds. And as the audience knows, for a few weeks, the swap dealer category of the commercial segment of the COT report had gone net long gold, and the hedge funds were essentially flat gold. Their longs and their short positions balanced out, and a lot was being made of that. And I was looking at that skeptically, like, this isn't going to last. And then the COT report that came out last Friday showed that as of the previous Tuesday, there was I think it was a 36,000 contract swing for the swap dealer category, whereby the banks went from being net long to net short. And I really didn't read much commentary about that, but I was looking at that and I'm like, oh boy, here we go. And then when today's Commitment of Traders report came out at 3:30 East Coast time, it showed that the swap dealers had gotten even more net short gold. The hedge funds had gotten more net long, and this is through Tuesday of this week, mind you. And then in silver, which again, a lot of people were making a big deal out of the fact that the swap dealer category had gone net long, but I wrote an article about it, and it was either on my blog or I might have written it for my Mining Stock Journal subscribers, where I said, don't buy into the hype of the fact that the swap dealers are showing a net long position in silver contracts, because there's another category of commercial trader called producer, merchant, processor, user, and the banks throw a lot of positions into that category, and that was extremely net short, and it's been extremely net short the whole time. But as of Tuesday this week, per today's COT report, the swap dealers had a massive swing in their silver position, and they went net short about 13,500 contracts, which may not sound like a lot, but if they covered that net short position, they printed a lot of money today. However, there's more here, because on Wednesday and Thursday, the open interest in gold went up 16,000 contracts. And I can guarantee you that was the banks shorting more gold contracts and using those shorts to cap the price rise that we saw in gold on Wednesday and Thursday, and particularly on yesterday. Because on Wednesday, remember, gold got hit below 1,300, and then it snapped back. I think it might have closed the day at like 1,304. And then yesterday it soared. And the same thing happened in silver. I mean, silver, I guarantee you the banks were even more net short going into today, silver contracts, than what it was being shown on the Commitment of Traders report as of Tuesday. So silver was up, something like 60, 70 cents yesterday. If the banks were only allowed to short an amount that matched the amount of underlying silver that they had to deliver, so they wouldn't have been able to feed shorts into the market to cap the price rise, I bet silver would have been up over $1 yesterday. About 10 minutes before the gold pit opened on the Comex, so around 8:10 New York time, the gold floor opens at 8:20 a.m. New York time. That's when gold started rolling downhill, and by 9 o'clock New York time, the damage was done.
And the way that these calendar dates and the cutoffs with COT occur in the reporting cycle, by the time we hit the next Tuesday cutoff, they'll be able to hide most of this change.
Well, today, the COT report that came out today through Tuesday, as of today, is irrelevant because the positions shifted around a lot. And who knows what it's going to look like. You're right, because they still have 2 more days of trading to shift around their positions to cover up what went on today.
Exactly. I mean, they put on a heck of a lot more new shorts, and then they'll be able to clean it up when the markets crash down, and then, wash, rinse, repeat, as we often joke.
Right. And the ironic thing about that is they could release a position report every day, but they don't. They want to keep the market as opaque as possible. So, by the time you look at the COT report that comes out on Friday, you're essentially looking at data that may as well have come out a year ago.
You and I have been making the argument about our living in a stealth bull market when it comes to precious metals, and we can turn to what happened this week and actually make the case that that's exactly what we're seeing. Yesterday we saw the dollar up. People were flying out of the Eurozone assets because they're a little, nervous about a continued accommodative stance when it comes to easy money and the ECB, even though Draghi made noises about tapering still further with their quantitative easing program. But suffice it to say, they're talking about interest rates being accommodative well into 2019 and being data-driven and all that other nonsense. So people were flying out of the Eurozone. They were, the Japanese yen was getting a bid, the dollar was getting a bid, and all the while, gold and silver were going up. Silver makes it into the 17-plus range. And that, is counterintuitive. People were moving into the precious metal space because the market is in a stealth bull market. And once silver and gold, gold over 13 handle again, and silver in 17, puts into risk the cartel losing control of the precious metal space and what that means for them. So, this all confirms, just with short-term trading data, what kind of psychographic profile, for like, if I want to go all geek on people, but it's underneath the market that we're looking at. We can see this from a reverse engineering of global macro logical concepts. The precious metal space overwhelmed the manipulators. It overwhelmed the cartel yesterday. That's basically what happened. And then they come back and smash the living bejesus out of the market at the Comex Open.
Well, let me guess. That's your story, and you're sticking to it, Eric.
I'm sticking to it.
I got to tell you, if you look at a chart of SLV, and I'm just using that as a proxy for silver, silver did nothing wrong technically today. You'll hear some nonsense by, in the Monday morning quarterbacks. Oh, no, SLV went below its 200-day moving average, and it's, at its 50-day moving average, blah, blah, blah. Well, there's a beautiful uptrend that started in December of 2015, and you can draw that line. It's almost a perfect uptrend line. It's actually an even more precise line that you can draw from early July through today, and SLV pulled back to that uptrend line, and assuming it holds that uptrend line, silver's going higher from here. If you use USLV, you can see it even better than you can on the SLV, because the USLV is essentially 3 times SLV. So we actually, in our fund today, we usually don't trade the leveraged fund products, but we put on a pretty decent sized position in the money SLV calls, July in the money SLV calls. And we did that in lieu of going long SLV, because I was able to pick them up with about 4 cents a time premium in them, which to me is a bargain. And we also went long USLV, a decent sized position. So if anything, I think what happened today, and again, it may carry on through next week. You can't, this trying to trade the precious metals is horseshoes and hand grenades. All you can do is hope you when you're doing putting on a trade to take advantage of a sell-off, you hope you're somewhere near the bottom when you jumped in. So, if anything, at least for now, this didn't bother. It bothered me because it's corrupt manipulation by the banks that the government looks the other way on, of course. But to me, I look at it as a buying opportunity, and for the magnitude of how much gold and silver were smashed today, I mean, the Huey index was only down 2.3%, and part of that you can probably attribute to the fact that the stock market was, at one point, was getting hammered. I think the Dow was down 250, 260 points at one point. Mm-hmm. So there was some correlation there with the mining stocks, with the amount that the stock market was down before it had its miraculous late afternoon bounce.
You were mentioning the silver trend line that's basically been asserting itself since the beginning of May, and that is interesting. I mean, silver frequently leads the sector, particularly when we have conditions of stagflation as an economic backdrop. And that's where we are right now. I mean, silver was going horizontal after its big pop, at start of the year, coming out of tax loss selling and all that. January was really strong, but then we, by first week and a half of February, got the snot kicked out of us. And we've gone sideways for the most part until May hit. And then May onward, we see this upward trend line. And, we got slaughtered today, Friday being June 15th. But the silver market is holding on. I mean, it was only a couple weeks back we were recording with people very worried about silver losing that central tendency trading zone of $16.50. That's where we landed. That's where we closed today at $16.48.
Yeah, I wasn't worried about it.
Continuous contract closing end of day basis. If people are going to look at a technical picture, I mean, gold is what the cartel was targeting. We jumped over the 200-day moving average yesterday on that move, and then lo and behold, surprise, surprise, the gold sector was attacked.
Right.
Pushing it, going below anywhere we have been basically all of the year.
Yeah.
On an intraday basis, wiping out all of the gain for 2018.
That's right.
Trying to paint the tape to give an impression that gold is falling apart. But meanwhile, when we look at silver is actually telling where the so-called stealth bull market rests. And it's in the context of a global macro picture of stagflation and the U.S. economy rolling over. That's bullish for silver and gold in turn. But they're trying to attack gold.
Here's the thing. I really hate that term stagflation. I mean, that was born in the 70s, and it was to describe a sluggish economy, or maybe an economy heading into a recession, and inflation accompanying it, which isn't supposed to happen. Well, I mean, the reason why we had inflation in the 70s wasn't because of the price of oil and OPEC. It was because the U.S. went off the gold standard and started printing money like crazy and started issuing a lot more treasury bonds. I mean,
well, actually, it's circular because the OPEC nations, in part, went aggressively towards forming their cartel to push the price of oil up to compensate for the value of the dollar declining.
That's right. Exactly.
They worked in tandem. I mean, it was a complicated, economic and political dynamic intertwined.
That's right.
Geopolitically.
That's exactly right. I mean, the oil price rise was a part of the inflation that occurred, but at its root, inflation occurs when the money supply increases at a greater rate than economic output increases. So
Keynesian economists would call that what happened when they look at history and describe it. They'd teach it as cost push inflation, but in truth, it actually was a monetary dynamic first and foremost, and then the OPEC nations and their cartel responding to it. In fact, even Kissinger was on board with this, and the recycling of the petrodollar standard and the birth of it.
Well, of course,
all of these things happened at the same time.
Right. They had to create the petrodollar because then the U.S. had a steady drug dealer to recycle dollars into treasuries, so it could just keep issuing treasuries. But yeah, essentially, inflation is money supply in excess of wealth output. Essentially, the simple way of saying it is you got too many dollars chasing too few goods. So what happens? The price goes up. The price of the goods goes up. It's the dollar, the value of the dollar gets devalued, and we're going to start seeing that. I think we're going to start seeing the effects of all this money printing start to come out. We started seeing it in the government CPI report. I mean, obviously, the CPI report isn't even close to what the real price inflation is that most households are experiencing, but it's gotten to the point where even the government can't manipulate its numbers to hide the fact that price inflation is starting to creep into the system. So, just to kind of circle back here, stagflation to me, it kind of imparts this idea that the economy is sluggish, and then we've got inflation accompanying it. Well, it looks like if you look at the economic numbers coming out of all the countries globally, not to mention the meltdown going on in Latin America, I mean, I would say we're heading into a deep recession. And the same thing can be said for the U.S. because we're starting to see, other than the government manipulated reports that are seasonally adjusted and statistically adjusted to make the numbers look better than they really are. The economic data that's coming out is from private sector sources is showing an economy that's starting to head south.
And when you marry that dynamic with central bankers trying to reduce their balance sheets,
or not expanding them as quickly as they were,
right? They're still relatively accommodative with their interest rate policies and clandestine swaps that they do when, for example, a couple weeks back, the Italian banking system is about ready to roll over. I mean, they're definitely out there putting out fires. But as the economy rolls over, which is in the data, that's going to pressurize the stock market, the general universe of the S&P 500. And the Federal Reserve is going to have to respond to that at some point because all of this is just a juggling effort of them trying to maintain asset values so as to create the shadow impact of economic final demand because of people believing that their assets are, in a better position than where they are. And that's not working anymore when it comes to the housing sector and the auto sector and the restaurant trend sales that we see and the rolling over here and there that speaks to data that isn't as manipulated as the unemployment report that we discussed in our last show.
That's exactly right. In fact, if you bring up the restaurant report, Black Box, an outfit called Black Box, polls something like 35,000 restaurants nationwide. They put out a monthly report, and for probably the last 25 months, the restaurant foot traffic has been going south. It's been negative just about every month, if not every month. The restaurant revenues had a couple months there where they went up. They measure it on a year-over-year comp store basis. The revenues went up, but with declining traffic, it tells you that the increase in revenues was solely a function of price inflation at restaurants. And this latest report, revenues were down a little bit again, and foot traffic was down even more. So to me, it reinforces and confirms the view that I've been writing about, especially in my short sellers journal, that the average household is getting squeezed when it comes to having disposable income to go out and eat. And you're seeing that in a lot of things now. Auto sales would be another example.
Returning to the precious metals space and what we're going to see in this summer doldrums period, and we have the perceptions when it comes to what the Federal Reserve is going to do in their policies, as well as the backdrop of the stock market for all intents and purposes chugging along for the time being. You know, we may just tread water for a good couple of months, but all of this seems rather untenable, even with the dollar having a bias to the upside. At some point, we're going to see the equity market roll over and reflect economic reality. Do you agree with that assessment? I mean, not necessarily trying to put a timeline on anything per se, but we are in this stealth bull market. We can see it in the prices of both gold and silver, and as resilient as they have been under this constant barrage of manipulation, and the dollar even rising at this point as well. How do you see the precious metal space going forward in the year?
Well, it's going to be interesting because I guarantee you India will show up on Monday, which for us is Sunday night, and they're going to be buying with both hands. And deliveries into the Shanghai Gold Exchange picked up this week. In fact, yesterday, the deliveries into the exchange might have been the highest I've ever seen it. And I get this data from a 3-time-a-day gold report that we get for our fund. It's kind of expensive, but it's worth it if you manage precious metals money. It's worth it to get it. It's called it's John Brimlow's Gold Jottings. But I can guarantee you India is going to be in buying a massive amount of physical gold on Monday, and so will the Chinese. I'm sure the Russians are. You know, the funny thing is, I thought about this earlier. You know, Trump's ramping up the trade war with China, and you know he lets the banks go in and massacre in a drive-by shooting the precious metals market. He's doing China a favor. Because now it makes it cheaper for China to buy gold next week, and they'll probably buy a lot of it. And same with India, same with Russia. So, you know, I think there's physical demand coming from the Eastern Hemisphere that's holding the market up. And you know, right now, I think that the best that the Western banks can hope to do is just keep the price contained to a degree.
That Eastern demand is what has been behind the stealth bull market of a year and a half plus.
That's exactly right. And in fact, Brimlow, I think it was about a week and a half ago, he had an article posted. I forget what the source was, but a Swiss, I don't know if it's a government employee pension fund. It was one of the official Swiss pension funds put $700 million of physical gold into their fund. So wow. it's not just the Chinese and the Indians and the Turkish, you know, the country of Turkey's imported a record amount of gold over the last 12 months. You know, there's a lot of entities out there that are not U.S. and not England and not Germany who are buying a ton of gold.
Well, Dave, the COT report will certainly be interesting when it's released, showing basically what we suspect will be a whole lot of nothing. They'll probably be able to hide the moves that they have executed in order to paint the tape, and we just saw it today. And time will tell where we go next week, but I think we're in a position to see the Asian market step up with physical purchases and the stealth bull market remaining intact. I mean, we certainly can see more downside and follow through to the downside next week, but you know, as it has frequently been the case after FOMC meetings, we have either seen in the recent year stability come to the market fast and things stabilizing for precious metals after FOMC moves because of the pricing in advance of the expectation of the Federal Reserve continuing to hammer the message about them normalizing their balance sheet and how people perceive that as a negative for gold. This summer is going to be interesting. We have the summer doldrums. But this fall I anticipate the stock market reflecting economic reality turning downward, and that should be a positive for precious metals.
Yeah, I think that's right. We're gonna, I think we're gonna start to see the housing market continue to roll over in the subsequent existing and new home sales reports that come out over the next few months. Those reports are already showing that, and I've got some interesting short ideas I'll present in my short sellers journal. That the next one is out on Sunday. I'm about halfway through it, and I've taken a couple week break from shorting the home builders, and I'll probably be back at it again next week, and I'll be talking about that. And I'll probably also have some ideas on Tesla, because I think Tesla's getting ready to roll over again.
And if people are interested in that, they can find Dave's work at investmentresearchdynamics.com. You can follow my work as I periodically post insights and reflection on what's going on in the markets. And for the time being, that's most easily found at facebook.com/Eric Dubin. This show is brought to you in part by Wall Street for Main Street, and you can check out all of the productions of Wall Street for Main Street by clicking on the YouTube channel. Thanks for listening. It's been an interesting week, and when we return next week, we'll pick up with analysis on what happened to precious metals and address whatever crazy fireworks is going on during the course of the coming week. Thanks for tuning in, and would love your feedback. Feel free to drop us a line. This is Eric Dubin signing off. Dave Kranzler.